That, yeah.
Very good. So, Nicholas, let's go ahead and move into your presentation on private markets, please.
Perfect. I'll just share my screen. Can you guys see it?
Yes.
Perfect. Okay, so hey, my name is Nicholas. So my topic for today is private equity market activity. This presentation kind of relies a bit on what Hayden talked about in his private equity presentation. So if something's unclear or if you want some clarifications, please ask. Even you can just stop me when I'm presenting. So I'll kind of go through historical activity, which is going to be a bit of a recap from Hayden's presentation, since he kind of did market trends in the end of it, and then I'll try to go to or move on to the current situation and look at private equity now and where it might go in the future. So kind of starting with deal activity. So the last 10 years, we've seen pretty upward trending deals or deal volumes and deal counts. So volume has been increasing around 12% since 2013 up until 2018. Once we saw a little dip in 2019 due to the worsening macroeconomic conditions. For deal counts, it's been a bit slower, which is kind of the interesting part here. So we've seen volume grow up faster than deal count, which has been partly due to increased valuations. So multiples have been going up consistently ever since the financial crisis. And it's also partly due to the increasing mega funds, which are funds with over 5 billion in pooled capital. And these have been pumping really large amounts of capital into larger deals, which has increased the volume quite a bit. Then for financing, the use of leverage has been increasing a bit. That's partly due to increasing in valuations as well. So as we can see on the top right here, valuations have been going up pretty steadily ever since 2009, and ever since 2009 up until 2014, the debt multiples have been going up as well. So buyouts have been using more debt to finance their activity, whereas after that you've seen pretty steady levels. Where the big difference have been is in leverage buyouts, where investor risk has been, or risk appetite has been increasing pretty significantly in the last few years. We've seen 75% of deals are leveraged over 6 times EBITDA, which is relatively high, which was 25%, I think, in 2010. So yeah, that's been highly due to higher risk appetite, which might be decreasing now that we're entering a crisis, and people are kind of dialing down their perception of risk or appetite for risk. Then for activity in the whole private markets. So private equity and the private markets in general, so venture capital and angel investors, have been pretty steadily increasing since 2009. And we've seen pretty drastic increases in fundraising. So in the bottom right, you can see the graph with the total amount hiking up to really high amounts. And this has actually increased the what you call dry powder, which is just capital reserves, or uncalled capital that the general partners have. It's been increasing to really high levels. I think it's at around 1.5 trillion for private markets in total since the beginning of 2020. For regionally, buyouts have been dominating in North America and Europe. If you look at private markets in total, in Asia, it's kind of the reverse. You've seen a lot of increase in venture capital and growth funds. The venture capital asset under management, so the sizes have been increasing around 30% year over year since 2010. This is partly due to the high economic growth and high demand for capital they have over there. Then for investment sectors, there hasn't been much change ever since the financial crisis. I think the biggest one is slight growth in the IT sector, both in deal count and in deal volume. So IT and software are probably the biggest one that have been growing. The ones that have been shrinking, you've seen energy sector shrink a bit, and then business to consumers. But in overall, it's been relatively stable up until now. There might be some shifts in the future. Depends on how the crisis molds the market. Okay, and then kind of going into the current situation where we're at now, and to kind of get a grasp on the situation in the private equity field or in the private markets in total. A lot of people have been referring to the financial crisis to see kind of how private equity tends to move in crisis situations. Although this differs quite substantially with the financial crisis, but there's still some similarities. And one of them is we're probably going to see a slowdown in private equity activity. So deal volume, deal activity is probably going to go down. This is probably going to be in the short term, with long-term view coming back up. And yeah, we're going to see deals and especially exits lower quite significantly. Then for heaviest losses within these funds, they're going to be incurred by probably funds with vintages of 2017 or later, which is vintage just means the first year they called down capital from their limited partners or LPs, and this is probably going to be partly due to these funds having to invest at relatively high valuations because of the hiking up of multiples, and what this crisis is probably going to draw down valuations as well. So they might incur the highest losses. Another part we might see is drop in newer funds. So starting funds might decrease quite a bit, especially with not established general partners without a lot of connections to limited partners, because fundraising is probably going to drop quite significantly as it did in the financial crisis. There's still going to be some activity with more established general partners with good connections. And the smallest hits are going to be probably taken by long-term funds that are going to be able to weather the storm, especially long-term funds with relatively high dry powder reserves. And then kind of go into deals within the current situation. So deal activity is definitely slowing down slightly. We've already seen a slight drop in Europe in Q1 2020, which also dropped valuations quite a bit from 2018 highs. We probably won't see such a drastic drop as in 2009, where it almost halved. This would probably be due to large reserves that these general partners had. Whereas last recession halted almost all capital raising for the buyout funds. So this drop would be limited by the availability of capital that these guys have. And another quite interesting part is we might see a quite significant drop in LBOs. And this could be partly accredited to the current credit situation for high yield bonds. So even though banks have a pretty decent credit liquidity, and the Fed has lowered interest rates pretty low, the banks are still staying away from high risk borrowing, which has made getting like high risk borrowing more expensive. And the bigger banks are just trying to kind of see through their current obligations. But we might see private borrowing increase outside the banking industry. For exits, this is the part that's probably going to take the largest hit, mainly due to lack of strategic buyers and the pretty bad IPO situation, like Victor discussed earlier. But yeah, buyers are currently assessing their own positions, so they're lowering capital expenditures and strengthening their balance sheet to kind of get through this crisis. Albeit some companies with really strong positions, such as Amazon, have been active in the acquisition field, with looking at buying AMC and Uber looking at buying Grubhub. But acquisitions are probably going to drop significantly and decrease the exits as well. And on the seller side as well, there's probably going to be a bit of a lack of supply, as sellers are trying to wait out the storm and kind of wait till the market recovers and sell at higher valuations later on. But then moving on after the crisis, there's a very good possibility that we'll see a really quick recovery in exit counts, as a lot of these private equity funds are sitting on very large asset portfolios. So I'm probably going to try to liquidate as well as soon as the market kind of bounces back. And then for other private markets, so VCs and angel or seed funding parts. So this is kind of, so in 2008, the main impact on venture capital and seed funding was a drop in valuations, but the deal flow had a relatively minimal impact, with only a 5% drop, whereas valuations dropped around 25%. And this is kind of realistic to happen again. Especially the venture capitalists are sitting on a large pile of excess capital or dry powder, and probably want to look at opportunities. There might be some larger or later stage companies that might not look for equity financing, which might draw down the demand for capital, as they probably don't want to sell equity at a low valuation. But I think earlier stage companies still are looking for capital wherever they can find it. And then one part of VC where we actually might observe a relatively big drop is with corporate venture capital. So corporate-backed venture capital funds, as their parent companies or their funders are trying to decrease capital expenditures as well, and might put investments at hold. But yeah, moving forward after the crisis for venture capital and seed, there's definitely going to be a lot of opportunities, as crises usually spark a new wave of innovation, which is probably going to drive up demand for capital. and create a lot of new opportunities for these investors. There also might be a shift in markets, but it probably will be quite small, as software already controls a majority of VC funding, and will probably in the future as well. One shift we might increase is increasing pharma and biotech, but that's what we'll see what happens. But yeah, in conclusion, there's definitely some short-term turmoil in the private markets, with bigger investments at home and general partners trying to look for opportunities. We'll definitely see drops in deals and exits across the board probably for the next 2 quarters. But probably they're not going to be so significant for venture capital or seed funding. But in the long term, there's definitely some opportunities forming up for all of these investors, with such high reserve capital, and private markets are probably going to come out of crisis relatively strong. But yeah, they also got some of the stimulus package from the U.S. government, which is kind of interesting. But yeah, that was I think that was relatively short, but any questions?
Very good, Nicholas. Thank you. So Dylan, I believe that you are the discussant here. Why don't you go ahead and moderate Q&A for a few minutes, as well as offer any of your own input or questions to Nicholas.
Yeah, so thanks for the presentation, Nicholas. So basically, I just had like a kind of question that anyone can jump into. So we obviously have like kind of the supply and demand side of new startups and investments in private equity. So when we see like drops or drastic increases in deals happening, are most of those due to a lack of investor confidence or a lack of new quality startups, or a combination of both in a kind of proportional manner? So what do people think in terms of, yeah?
I can kind of start with that. I think it depends a lot on the situation. I think especially in the last financial crisis, I think the biggest impact was like loss of liquidity in capital, where you didn't have as much access to capital for startups and early stage ventures. I don't know if that answers your question.
So why is it that these private markets, which are pretty much designed to not be really short-term thinking, and we're not looking at things on a quarterly basis, but we're willing to take the long term, why is it that we're concerned about their reactions in the COVID area, where we have what is obviously at least a short-term issue?
Well, I think it's partly due we really don't want to dry up the liquidity side of capital for the private markets, and in this case, I think a lot of these or a lot of private equity funds, even though they're sitting on a lot of capital, they don't really want to take any unnecessary risks due to the current macroeconomic conditions.
So this is also a question for anyone that wants to jump in. So now that we are in the COVID era and we are kind of seeing the government try to maintain consumer demand through stimulus checks and different things like that, how do we think the trends will change in terms of like services from like remote style services and just different things where, you know, people don't have to interact. How do we see like the trends of business and these new private equity deals going down?
I have a little bit of an input on that. So it's very interesting because a lot of fast food restaurants, for example, let's talk about that. They're doing drive-through sales. They're not allowing people to go into the restaurant and dine in. And restaurants are also doing curbside pickup. One thing, for example, is a lot of business people have said that while we're trying to move towards trends that allow people to stay inside and at home rather than outside, have all started way before this pandemic hit. A good example of that, like I was saying, the food industry. McDonald's, for example, is just starting to allow people to go inside of their restaurants. But way before COVID-19 hit, 2/3 of their sales were people driving up to their windows and buying food. So while yes, we're trying to encourage that, I just think that COVID-19 is making that kind of go a little bit faster, because I think we were already moving towards doing a lot of things remotely. An example is Twitter is saying that their employees don't really have to go back to their office. Even after we find a vaccine, blah, 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 they're still going to be able to work from home.
So Gary, that's an interesting point. We've seen that this crisis has been more a crisis of short-term transaction volumes for virtually anything you might want to think about, and a crisis of confidence in part because of that and uncertainty. But also, we've seen that it's really just sped up other trajectories. So the disruption came rapidly and has simply sped up trends that are already taking place. So with the possible exception of liquidity. So, you know, interest rates were already really low, capital availability very high, and now we see liquidity is virtually seized up, not as badly as in 2007, 8, 9, but virtually seized for capital acquisition. Why is it that liquidity is seized? And I think that this comes back to both Niklas and Victor, because liquidity is important both to the private and the public initial markets. Why is it, do you suppose, liquidity has become such a problem?
Well, I can go first a little bit.
Okay.
I think just in the cost of cash has obviously become greater, and I think when we're looking at the private equity space, I think it's because, but when they're looking in their own portfolios, the companies what they have, and still they have some cash available, they won't do any new acquisitions because they're not sure yet that what the impacts on their current portfolio companies will have. So what that initially means that they're saving that liquidity cash to access then the companies that they already have and help them to get out of the pickle. That's how I would see that, why they're so strongly holding on cash rather than spending it at the moment.
Okay, Niklas, any other comment?
Yeah, I think it kind of plays a lot into uncertainty and just trying to minimize risk, because you have no reference point on exactly when you might get out, and I think that plays kind of a major part.
Yeah, I would tend to agree with both of those. I think it's an issue of uncertainty more than anything else. Jens, any comments with respect to this before we move into safes?
I only have one comment. I would actually like to disagree a bit with Victor. I would claim that the cost of capital or the cost of cash has actually gone down, and that's because interest rates are practically zero at the moment, and other kinds of investment grades and high yield bonds also follows. So that means that it's simpler to finance private equity deals, especially with a debt instrument.
I have a good answer to why.
So I was actually, I actually wanted to ask Nicholas when he was showing that chart with the multiples financing as a part of debt and equity. If he was thinking, do you think that the multiples of debt in private equity deals will go down?
Well, yes. First of all, let me go back to the cost of capital you kind of talked about. So you've seen especially banks try to focus more on low risk, and you've seen actual jumps in high yield bonds, even though with the low interest rate environment. So leverage buyouts, which are traditionally financed with junk bonds or high yield debt, is the cost of that has gone up quite significantly in the last few months.
So we're seeing something kind of interesting here, and I'm glad you pointed that out, Jens, because I had the same thought as Victor referenced that. But we see two different sides of this. On one hand, yes, the cost of cash, the cost of some of these debt capitals is extraordinarily low, maybe even historically low, right? But simultaneously, we see, of course, that the return on having cash is also low, because return and cost are two sides of the same coin. That said, we see companies, institutions, and individuals hanging on to cash at the moment, which normally is only done when we get good returns on cash or liquidity. We see them hanging on. And it's because cash has become a precious commodity, because we don't know how much cash we need for how long, given the current conditions. So yeah, the cost is low, but maybe the benefit is higher than current costs and returns are disclosing and revealing.
Thank you, Rick. I think so. I just wanted to say at the end that the reason why I said that the cost of cash is gone up is exactly why the reason Rick explained. And also, I wanted to argue on that space furthermore to that the cost of cash has gone up also because if we're looking at companies who have a lot amount of shares in publicly traded companies, meaning that they will need to sell their shares to access that cash on a discounted price, meaning that the cost of cash will then be higher because they will make a loss of that sale because they have to access cash. So transactions like that may be then the case that the cost of cash has gone up.